Welcome back to Nexus. I'm Jennipher, and today we're diving deep into a topic that's at the heart of every transaction, every market, and every policy decision: trust. Yes, trust, the invisible glue that holds our economies together. But here's the thing: trust isn't just a feel-good concept. It's a delicate balance of risk and reward, and when that balance tips, it can lead to massive consequences. So, how does trust work in economics? Why is it so crucial? And how can we make sure we're getting it right? Let's break it all down. To start, let's talk about the anatomy of trust. Trust in economics is all about expectations. Expectations that the people, businesses, and institutions we interact with will act in a way that's reliable, fair, and competent. Think about it. When you buy something online, you're trusting the seller to deliver what they promise. When you invest in a company, you're trusting its management to make sound decisions. And when you pay taxes, you're trusting your government to use those funds wisely. But trust doesn't come without risks. When we place trust in someone or something, we're taking a leap of faith. We're exposing ourselves to the possibility that things might not go as planned. On the flip side, trust also offers rewards, like convenience, growth, and stability. Balancing these risks and rewards is what we call the trust equation. Let's look at some real-world examples to see how this equation plays out. First up, financial markets. Financial systems rely heavily on trust. Banks, stock exchanges, and even cryptocurrencies all depend on our belief that they'll function as expected. But what happens when that trust breaks down? Remember the 2008 global financial crisis? Risk-taking spiraled out of control, trust eroded, and the entire system nearly collapsed. It's a stark reminder of what's at stake when the trust equation isn't balanced. Now let's shift gears to consumer behavior. Think about the last time you ordered something online. Did you read the reviews? Maybe you checked the return policy. That's trust in action. Companies like Amazon and Airbnb thrive because they figured out how to reduce the risks of buying or booking online. But trust can be fragile. A single data breach or a bad customer experience can make consumers hesitate. That's why companies invest so much in building and maintaining trust. And then there's public policy. Governments need trust to function effectively. When citizens trust their leaders, they're more likely to comply with laws, pay taxes, and support public initiatives. But when trust is broken, say through corruption or inefficiency, it can lead to unrest, instability, and even economic downturns. The trust equation here is incredibly delicate, and the stakes are high. So how do we build and sustain trust in these different areas? There are 4 key building blocks: transparency, accountability, reputation, and technology. Let's break these down. First, transparency. This means being open about policies, pricing, and potential risks. Take companies that share their supply chain practices or governments that provide clear budgets. Transparency reduces uncertainty, making it easier for people to trust. Next is accountability. This is about taking responsibility for actions and ensuring there are consequences for wrongdoing. Regulatory oversight, independent audits, and whistleblower protections are all ways to enhance accountability. It's why ESG, environmental, social, and governance criteria, has become such a buzzword. People want to know that businesses are accountable not just to shareholders, but to society as a whole. Then we have reputation. A strong reputation can act as a safety net during times of uncertainty. Think of companies like Apple or Tesla. Even when they face challenges, their track record of innovation and reliability helps them maintain trust. Finally, there's technology. Innovations like blockchain are revolutionizing the way we think about trust. Blockchain's transparent and immutable records reduce the need for middlemen, offering a new level of security and reliability. But trust isn't always a good thing. Misplaced or excessive trust can lead to disasters. Ponzi schemes like Bernie Madoff's exploited trust for personal gain, leaving investors devastated. Corporate scandals like Enron or Theranos show what happens when people trust the wrong leaders or promises. And overconfidence in markets can lead to bubbles that eventually burst. These examples are sobering reminders that trust needs to be paired with vigilance. As we look to the future, trust will become even more complex. Digital trust is emerging as a critical issue. With AI, big data, and digital currencies on the rise, how do we ensure privacy, security, and ethical use? Cross-border trust is also vital as globalization deepens. Countries need to trust each other to uphold trade agreements, address climate change, and manage global crises. And resilience will be key as we face disruptions like pandemics or natural disasters. Systems that can adapt while maintaining trust will be the ones that thrive. So, what's the takeaway? The trust equation isn't a static formula. It's a dynamic balance that requires constant attention and effort. Whether you're a consumer, a business leader, or a policymaker, understanding how trust works can help you navigate risks and seize rewards. That's all for today's episode of News Nexus. Trust may be invisible, but its impact is everywhere. If you found this topic as fascinating as I do, make sure to like, share, and subscribe to stay updated on more in-depth explorations of the forces shaping our world. I'm Jennipher, and I'll see you next time.